So before we proceed with our first speaker, I would just give a quick introduction about our company, Global Financial Consultants. It's a financial advisory company regulated by Monetary Authority of Singapore. It was initially established in Sydney, Australia by Ian McMahon and Bruce Barrett in year 1997. And in year 2003, the business relocated to Singapore. And since then, we have been helping our prospects and clients with their personal financial planning, be it savings, investments, or retirement planning, or children's education fee planning, or pension transfers like SAFE or CPF investment, as well as protection and insurance. So that's about GFC. And yes, our main aim is to build a long-term relationship with our clients by giving an unbiased advice and reaching their own financial goals. Recently, GFC has also been nominated as one of the top 10 financial advisory company here in Singapore by Singapore Finance. So that's a great achievement. And yes, so that's about GFC. I will quickly give an introduction about Philip, who will be our next speaker. So Philip is the director and founder of Halwyn Capital based in Edinburgh, UK, which is authorized and regulated by Financial Conduct Authority. He has over 20 years of experience in fund management, product development, and distribution. He started his career at Scottish Widows in Edinburgh, managing UK equity funds, before switching to multi-asset funds in 2005. He then moved to Emirates NBD Asset Management in the UAE in 2009 to continue managing multi-asset funds, and subsequently started his own firm, Halwyn, in year 2017. He will be talking about inflation and the importance of diversification in your portfolio. So over to you, Philip. And if you need any topics on your thing, just raise your hand and someone will assist you. Thank you.
Thank you, Rohit. I'm just going to turn on my screen share. Just bear with me for 2 seconds, please. Okay. Good evening, everybody. Hopefully you can all see those slides okay and also hear me. Thank you for the very kind introduction as well, Rohit. So I don't need to say anything more about myself, and we can just dive straight into talking about the subject matter this evening. So the intention is to give you a little bit of a flavour of what's going on in the market, some of the things that are important and driving that at the moment. And key within that is obviously what's happening with inflation, but also in terms of diversifying your investments within your portfolio. I do need to start with a disclaimer here, obviously talking about investment related matters, and the content of what I'm going to tell you, please consider this for your general interest only. So while I'm a regulated professional here in the UK where I sit, I'm clearly not regulated in Singapore to be providing you with personal investment advice. And everybody listening to the presentation here will obviously have their own particular circumstances and requirements. And therefore, if anything I say tonight is of interest to you, does spark your thoughts going on a particular subject, please do speak with your hosts at GFC afterwards, who clearly are regulated within Singapore, and to give you some personal advice as to how anything I might say could perhaps be of interest to yourself or relevant to your own financial setup. I do like to start with a quote sometimes. This is a great one from Warren Buffett. Warren Buffett, I'm sure you may be familiar with the name, 60-year history of investing. And I've very deliberately picked this one because a lot of what is going on at the moment, there's a lot of volatility going on at the moment in the global markets across asset classes, driven by some short-term factors. And this quote is a great one, I think, for just bringing back our focus on the fact of what we're trying to do with investors is very much geared towards a long-term result, not about what happened last week or what might happen next month. And to get good portfolio returns, it does require that long-term approach. In terms of what we're going to look at, I'll run you through some current events and how that's impacting on the global markets, and then we'll kind of dive into why, therefore, a diversified approach can make sense for a lot of investors before concluding things at the end. So what's happening now? What's going on? What's kind of making the news? What's moving markets day to day as we stand just at the moment? Clearly, the ongoing conflict in Ukraine and Russia is having a very significant impact. But before that even started 5 weeks ago, there were some very significant underlying trends going on in the market related to inflation, related to how central banking authorities intend to tackle the challenge of inflation in terms of managing that. That's a core component of the majority of central banks' mandates to manage price stability, inflation, if you will. We can't quite forget COVID just yet. It's been with us for a couple of years, causing all sorts of problems here, there, and everywhere. It hasn't quite gone away yet, so we'll very briefly touch on that as well. But also, in addition, we have a lot of asset price volatility at the moment in terms of what equity markets are doing, in terms of what fixed income markets or bonds are doing, as well as commodities in addition. So for many of you, aside from the fact that, obviously this is from a humanitarian perspective, a very significant and unpleasant crisis that is currently underway in Ukraine and Russia, from the global economic and also financial market perspective, there's also various impacts that this is currently having. On the left-hand side of the screen here, you can see some of the details listed about how Russia and Ukraine supply the world with all sorts of things that the world around us needs, be this energy, be it food, be it commodities. In terms of oil, they're one of the largest producers and exporters of oil. Gas, they're a very significant producer of gas. They supplied a lot of European gas, especially to Germany. So this creates a very difficult political situation, but also a variety of other commodities as well: gold, diamonds, nickel, and I'll touch on nickel on the next slide. Food is another important component. Not only do Ukraine and Russia between them produce a lot of food, a lot of wheat, almost a third of the global supply, they also produce a lot of the fertilizer. So even if countries aren't buying the food directly, they might be buying the fertilizer to grow their own food within their own countries. And so there's some really big impacts going on here, which will feed into the inflationary spiral we currently find ourselves in. But also, aside from energy and food, industrial products are not without some impact either. Semiconductors, an industry that's had a lot of disruption from COVID over the last couple of years and capacity constraints, is also getting impacted by what's going on, because, believe it or not, 70% of the global neon gas supply comes from factories in Ukraine. And so that has an impact on semiconductor manufacturing, just perhaps when that industry was getting back on its feet. Car manufacturing not only relies on semiconductors, but also a variety of other components. And we've seen a lot of the European manufacturers, the German ones in particular, such as Audi, BMW, Mercedes, VW, who have also had to have production shutdowns through the month of March, because they get some core supplies that come from Ukraine as well. In this case, wiring harnesses. Cars have a lot of wires in them. Wiring harnesses help bundle them together. You might not think that's the most critical part, and it's not the engine, it's not the wheels, let's say, but you still need all these pieces to complete a finished product. And so therefore we have ongoing production disruption. And when we have disruption to production, whatever the good is, whether it's a car or something else, that has the implication of disrupting supply and therefore impacting on prices. I won't spend too long on this one. This is quite an interesting one. If you're not familiar with what's happened in the nickel market the last month, I'd really encourage you to perhaps go away and read about our presentation if it's of interest. Nickel is something that's actually used in a variety of things, predominantly in stainless steel. Well, we obviously use stainless steel for many things, but also in batteries for electric vehicles as well. And through March, we've had a real kind of difficult situation in the nickel market, and it's been described as being broken this month in terms of what's happened, because we've had something called a big short squeeze, where you often get participants in markets, be it commodities, equities, all sorts of markets, where people take different positions. They can be long an asset, they own something, they can go short of an asset because they're hedging or they expect a price to fall. And through March, we had a very unique situation where the price of nickel went from essentially $25,000 a ton to getting pushed through $100,000 per ton. So it went up 4 times in the space of about a week or so. And it actually led to the London Metal Exchange cancelling a whole series of trades worth billions of dollars. And this was, this is something that flows back essentially to the Ukraine-Russian situation, where some participants in the market have exploited some disruption to supply to cause some real problems. And if we look at this next slide that just shows what's happening to some commodity prices, and we're going to come to look at inflation. And when we look at those inflation numbers in a second, just think about this slide here. The green line shows what's happened to the nickel price so far this year, and you can see it's up 70%. Towards the right-hand side, though, we've got a long flat section, and that's the long flat section where the LME, the London Metal Exchange, closed the market for a week. And if we kind of erase that closure, and if we showed what happened on March the 8th when the price went to $100,000, that green line would be significantly off the top of this slide, you know, 300% plus gain. But regardless of that, it's still up 70%. And if we look at some of the other commodities noted on there, gas, oil, wheat as well, we can see some significant price increases there between 43 and 54%. So we've got a lot of other factors that are still yet to flow through that are happening now but haven't really impacted on behavior, on spending, on growth, but are still to come. And we're sat with an oil price today of on Brent of about $112 per barrel. That is a challenge for economic growth. It's a challenge for spending because it's a cost that you have to bear, and that impacts your ability to go and spend on other things. If we look at some inflation numbers, so on this chart we have a couple of US inflation numbers, the orange and blue lines. We have a Eurozone inflation number, the purple line. So the orange one that comes out at the top there, it says 7.87%. If you can't quite make out the numbers on the right-hand side, is at a 40-year high. Now, this is before we've seen the impact, if you will, of some of the current challenges that are going on in food and the energy markets, partly related to the Russia-Ukraine crisis. There's also some very strong arguments to suggest these numbers are much lower than they should be, and that they don't actually reflect real world inflation, which is potentially much higher than this. For example, in the US CPI number that we're seeing at 7.87, the cost of housing is about 25% of that, but the component within that inflation calculation is in low single digits. The real world house price inflation is significantly in double digits if you're looking at house prices or rental increases. And so there's some quirks in how these numbers are calculated that would suggest they're massively underestimating. And you'll see from the comments on the right-hand side that these are trends that weren't really well predicted. And the US Federal Reserve, who kind of have the mandate to try and oversee this, really kind of dropped the ball on this. They thought inflation would be transitory, as COVID receded, that it would drop away, and it really hasn't happened, and we potentially got a lot further to run. And that's clearly an issue for anybody with assets, with investments, with savings, because if you simply put your $100 in the bank and inflation is running at 8%, in a year's time, those $100 will buy you $8 worth less of goods than they will buy you today. So you are losing value with high inflation. So the response to this is that we'll start to see interest rates rise. And I've deliberately done this as quite a long-term chart going back to just before the year 2000 to provide some context. Again, the orange line here are US interest rates, the blue is UK, and the purple is Eurozone. And on the very far right-hand side, those orange and blue lines have just started to tick up. They will go up significantly further from here. We've had the first 25 basis point or 0.25% rate rise in the US. We've had a couple of small steps in the UK. The US is on track to have a series of more interest rate rises, potentially at 0.5% stages each time for the next few months, possibly, with a view to trying to get on top of this inflation problem and bring it down. And at the same time, we've also got their stimulus program that's been running for the last 2 years since COVID started, winding down as well. So this is going to create a lot of pressure for markets. And I mentioned COVID just earlier. We can't quite forget COVID just yet. There's various parts of the world, and obviously where you are in Singapore and places such as Hong Kong, there's a lot of restrictions in Hong Kong. There's a lot of problems with the infection rates at the moment. And China, having adopted kind of a zero COVID policy, also has some challenges. And this chart here is just demonstrating what's happening in Shenzhen in terms of volumes of containers in the early part of March, running through kind of the first half of March. In Shanghai, again, I'm sure you're probably familiar, there's 25 million people in Shanghai. They've just entered into a 9-day, 2-stage city lockdown starting a couple of days ago. And while the port of Shanghai remains open, there's probably a lot of landside congestion. So some of those factors that help drive inflation numbers we looked at on the previous slide higher, which is some of that production disruption, has the potential to still carry on. We're not out the woods yet in terms of upsetting the very fine balance of some of those global supply chains, which have an important impact in terms of the direction of pricing. And if we look at cases, this is looking at some of the highest case rates that we have, and obviously the peaks on the right-hand side, as we saw the Omicron variant come out late last year, have been significant, much more significant in terms of infection rates than previous 2 years. But obviously the good news is the vaccination program around the world have helped minimize the impact that they've actually had on people's health. But the point being, we still have this pandemic with us, unfortunately, and it hasn't quite gone away yet to be forgotten. So let's have a look at what this is doing to markets. So I'm going to show you a few slides here that look first of all at equities, then we'll look at what's happening in the fixed income market. The first slide here is what's happening in the here and now. So the slide on the left is what's happened this month in March. It's been a pretty bumpy month already. The slide on the right is what's happened so far this year. So three months, if you will. So fairly short time periods we're looking at to start with initially. And we've got the USA, which is the purple line, UK is the orange line, blue is Europe, and green is emerging markets. And you can see on the left-hand side, the US has had quite a strong bounce back, having started the month really badly. All markets started started March very badly. The last 2 weeks have seen a significant rally in the order of 10% or more. As we look on the right-hand side, what's happened so far this year, the majority of equity markets are still down. The UK just creeping into positive territory, but despite this 10% rally we've had the second half of March, the US, Europe, and emerging markets are still in negative territory. But let's put it in a bit more context. So let's look at 5 and 10-year charts as well, which just kind of give us a slightly longer term view. And you can see here there are some very clear differences between what the US has done and what a lot of the rest of global markets have done, if you will. With the purple line of the US racing ahead by some very, very significant margin. And this has been driven by a variety of factors, but especially in the last couple of years, in the response to the COVID pandemic, in terms of the low interest rates and the stimulus we've had out of the US Federal Reserve and also the US government. And it has really driven asset prices to a significant level and well above their long-term trends, their long-term valuation trends as well. And that is something we've got to be cognizant of and aware of at this stage as we stand today. And if we look at valuations, this comes from a website called FinViz. It's referenced down the bottom left corner. They do some great graphics like this that if you have a chance to play around with their website, please do. It's quite interesting. But this is looking at the valuation of some US equities using their forward price to earnings ratio. So it's looking at the price of the stock relative to the earnings of the company. To describe how this chart works, the bigger the box, the bigger the market cap of the company. So on the far left, you can see Apple and Microsoft, the top left hand corner. The biggest boxes, they have the biggest market caps. The color schemes then relate to the level of valuation. So the brighter red it is, the more it's expensive. The greener, the less expensive. So if you see a lot of big bright red boxes, that means we've got some big companies on expensive valuations. And Tesla, I think, is always an interesting one to pick out. You can see it towards the top right-hand side. It's got a rating of 85. So that means if you buy shares in Tesla today, it will take 85 years for you to recoup your investment if they were to pay out 100% of their current earnings or the next year's forward earnings, which is quite a long time for a payback on an investment, in my view, and obviously it incorporates a lot of faith. When you think that the long-term valuations for the US equity market would probably be closer to 16 to 17 times in terms of PE ratios, to see companies on 85 or 46 or 27 and 29 like Apple and Microsoft, you can tell that we're still in quite frothy territory in terms of where equity market sits. In terms of fixed income, so these charts are showing you the yield. So we've flipped around from what we showed you on the previous charts, which was equities. So in equities, a rising line on a chart is good news. When you're looking at fixed income yields, a declining line, as we see on the chart on the left, the majority of the chart on the left is what you want to see. That's good news. It means your yields are declining, which means your prices are rising. So that's good news for bond investors. So you can see on the chart on the left, the US Treasuries for the last 45 years almost have been a great investment. We've seen yields falling away. We've had a massive long bull market in those. If you look at the chart on the right, however, what you'll see is that since the start of the pandemic and anticipation, if you will, of rising rates, actually yields have been starting to rise, and they've gone from 0.6% to the best part of 2.5% today. They're dropping back a little bit just today, in fact, but kind of around the 2.5% mark, which has been not such good news for investors in fixed income, especially if you're invested in government bonds, which are typically seen as a low risk part of the market in which to have your assets. And if we look at the quarterly returns from the Bloomberg US Treasury Index, so this is going back to 94 up to the current quarter and as at today. So the purple bar on the very far right-hand side of this chart is what we're seeing for the current quarter we're in, so the year-to-date performance, if you will. And you can see it's sitting at just a fraction shy of -6%, which has been the worst quarterly return in the entire time period of this chart, and actually going back before this time chart as well. So going back more than 30 years, this has been the worst quarter for fixed income, and we can see the impact of that on this chart on the right-hand side, that sharp spike as yields have risen, prices have fallen, and led to a terrible return from certainly US government bonds over the last few months. And this is important because bonds are often seen as a very good indicator of what is to come, perhaps more so than equities. Equities get a lot more frothy, a lot more volatile, and the US Treasury yield curve, so looking at the different interest rate yields across different maturities, can often be used as a signifier of potentially what's to come. And you may have seen, if you've been following the news over the past week or so, about people talking about an inverted yield curve. Now, an inverted yield curve is essentially where short-term US government debt is yielding a higher level than long-term. So i.e. It's costing more for them to borrow money over 2 years than it is, let's say, over 30 years. And that, looking at the chart on the right, has historically been a signifier of recessions to shortly follow thereafter. If you think about, well, why should an inverted yield curve mean a recession? If you've got an inverted yield curve, it's because the bond market is anticipating increased interest rates from the US Federal Reserve. So increased interest rates is the US Federal Reserve trying to get on top of inflation. When unemployment is low and inflation is high, they will start to put up interest rates. As it notes on the right-hand side there, this has happened for the last 8 recessions, have been preceded by, if you will, rising interest rates and inversion of the yield curve, which we're not seeing currently today. We have seen it intraday this week so far, but it's a signifier that there are challenges ahead. And certainly from the US Federal Reserve's perspective, their ability to manage economic growth and slow down inflation when it gets too high, but without tipping the US economy into recession, has been found wanting, and they haven't managed it on the last 8 occasions. And we're now in that scenario again where we've got rising interest rates, so we have to be careful looking forward. So in terms of what to watch out for, in terms of our day-to-day news flow and what's happening, obviously what continues to happen in the Ukraine-Russia conflict is very important in many different ways. But even taking that completely to one side, inflation is still a challenge. We have a lot of energy and food inflation that are not in the current numbers. The oil price is north of $110. Interest rates are going up and bond yields are inverting. So these are the things that will certainly over the short term continue to have a big impact in terms of what the markets are. And this is where diversification comes into play. This is a slide I've used for many years when talking about diversified investment strategies to demonstrate a point, if you will. And the point sought to demonstrate by this chart is the variability of returns from different asset classes. So the purpose of it is that when you look at this, hopefully it looks like a crazy mad jumble of color with a somewhat random allocation of boxes across that slide. And that is the whole point of it. Each box represents an asset class. Each column, if you will, is then ranked from best performing in that calendar year to worst performing at the bottom of each column. And you can see that you can have asset classes. If you look at the yellow boxes, which are property that stand out, if you look at the black boxes, which are US equities, you can have assets that are either at the very top, but the next year can possibly be at the very bottom. And there's a certain random walk. And the point therefore being made here is that we can't predict from 1 week to the next, 1 year to the next, how this table will look. And if you try and chase historic returns, which is what a lot of investors get drawn into, look at what's gone up the most the previous year and fill your portfolio full of that. The danger is you can get exposed to something that next year might be the worst performing asset. And This is where diversification comes into play. And if you have a mix of different asset classes in your portfolio that is targeted at your particular risk profile, your risk appetite, how much risk is either A, suitable for you, and B, what you are comfortable in taking, that is a better long-term approach. You will not in the short term ever be at the top of this table in any one calendar year, but you're never 100% in the best performing asset. But the flip side is you're never at the bottom of the table, and not being at the bottom is what matters. Because what this slide shows us here is when you lose money, how much you have to do to make it back. And if we look at the center of this chart, what this is showing us is that if you make a 50% loss on an investment, you have to do 100% to get back to your start point. So your $100 goes from $100 to $50, you've lost half of it. If you make a 50% gain, you've only gone back to 75. To go back to your start point of 100, you need to make 100% gain. And the point it's making is very simple, which is it's not about the good years that drive your long-term returns. It's about what happens in the bad years. What happens when we have geopolitical events, when we have recessions, when we have pandemics, and how did your portfolio fare in those? Because the more diversified it is, the better it can absorb those kinds of events when they occur, and they will occur inevitably over time. And that actually sets you up for better long-term returns over time. So one of the things that I do at Halwyn Capital is I advise various parties on various investment models and approaches, and we have one that we call our moderate strategy. It's kind of a middle of the road strategy for people with a moderate or balanced risk profile, if you will. It's split across equities and fixed income, alternatives and cash. And what we're showing here with the pie chart on the left is where our current positions sit for this model. Normally, they would be 60% equity, 30% fixed income would be the neutral allocation. And you can see from here, we're currently at 55 and 26. So we're underweight both of those, as well as a little bit underweight alternatives, and we're overweight cash. Cash is not a great long-term investment, especially when inflation is running at 8%. However, in the current environment, we've just had the worst quarter on record for US Treasuries for many decades. It's good to be slightly underweight fixed income just now. And we've also had a pretty challenging quarter for equities, and equities aren't out of the woods yet in that sense. But a very important point to make is before anyone gets too carried away and thinks, well, if we've got these challenges, let's just sell everything and just go and sit in cash, is, well, that's not a good thing to do either. And so what we do with these models is aim to provide some tilts that take account of some of what's going on around us, but they don't fundamentally change the long-term goal of what this strategy is trying to do. Because, you know, as I've said a couple of times, none of us can 100% predict the future. Who knew 2 weeks ago that the equity markets were going to go on a 10% rally and US Treasury is about to have their worst quarter in 40 years? You didn't find, you know, many people talking about that when equities had just had a massive crash for the preceding 10 weeks. So, you know, markets can always surprise us. And without the ability to be 100% accurate in terms of what will happen tomorrow, next week, next month, we take the long-term approach. So in terms of how this plays out across those equity allocations, we deploy the money as smartly as we can and as cost efficiently as we can. For certain parts of the market, we'll use some very low cost assets such as ETFs, which keep our overall portfolio costs down. And where we have some active managers that perhaps add some value in certain parts of the world or on certain strategies, we'll bring those into play. On the fixed income side, you know, we're very cautious around what happens with government bonds. So we don't have much allocation there. We've tended to allocate more through some higher yielding strategies, such as emerging market debt and high yield as well, for example, as a way of making this an efficient but still interesting place to try and generate some returns from. And in terms of how this works for GFC is that there is a multi-asset fund that GFC have access to their clients that's registered for distribution with clients in Singapore. And if this is something that is perhaps suitable for you, you may find in your next conversation with GFC, perhaps it's mentioned. Obviously, everybody's circumstances are different, so that will depend very much on that conversation with your host at GFC. But to wrap it up, and just to open it up to any questions, should anyone have any, as we come to the end of the conversation, there's an enormous amount of noise. There's an enormous amount of volatility going on at the moment. And it's very easy to get sucked into whatever, you know, the latest talking head on Bloomberg News or CNBC or whichever news channel you might occasionally flick past is talking about and looking to justify why the market's done this or that. In reality, on a day-to-day basis, a lot of what drives markets is more by algorithms, news flow, and tweets. What drives them long-term is fundamentals. there are undoubtedly some challenges on a fundamental perspective. We will continue to see short-term volatility. The major asset classes have some challenges, but at the same time, I would not want to dissuade you necessarily from being invested at all, because we know over time what the long-term trends are. But it is very important to ensure that you have something that is suitable for you, that has some diversification in there. And that, for a lot of people, is often the most sensible approach to be taking in terms of how they approach the markets. We can never quite predict. If you rewind the clock a couple of years ago, nobody was quite expecting inflation to go through the roof, a global pandemic to shut down half the world, and a major conflict to break out in Eastern Europe involving a nuclear-armed power with a bit of a crazy guy at the helm. So we never know quite what's around the corner, so we have to plan accordingly for that. But there are still some good opportunities. There are still some interesting opportunities in fixed income, despite what's happening with rising rates. And so, providing it's done in an appropriate manner, there are still some good opportunities for investors. So I'm going to stop talking there. That's brought me to the end of kind of the formal section of slides I had. There's possibly a few minutes left, so I'll throw it back to our host at GFC. And if anybody would like to bring any questions, I'm more than happy to take those at this point.
Any questions?
Thanks, Phil. That was extremely well put together. What do you think about gold?
Gold's an interesting one. So I, brutally honestly, am not a great fan of gold over the long term. It's a lump of shiny metal. You dig it out. It's not productive in any sense. It has no cash flows, no dividend streams associated with it in the way that equities or fixed income as an asset class can possibly have. However, if you were noticing, as I flick through the moderate strategy slide, there is an allocation to gold in there, and that is simply a reflection of the fact that at certain times, regardless of what I think is a long-term asset, gold can actually have a good stabilizing impact in. And when we have periods of geopolitical uncertainty, when we have periods of high inflation, when fixed income is challenged by rising interest rates, gold can be a useful asset to hold. It's been around for thousands of years as a store of value, if you will. And so whilst I don't think it's necessarily a great long-term asset and doesn't have those cash flows necessarily, I think there is a time and place. And that's one of the lessons you kind of learn when you've been in the game long enough, that you'll have a particular style of investing. There's certain things that as an investor that I like to invest in, but the things I like aren't necessarily always the best performing assets year after year after year. We have cycles. And I think where we are at the moment, we are in one of those periods of time where gold is not a bad store of value. How much money you make from it on the upside is not necessarily what it's about, but it's about protecting ourselves on the downside as much as anything. So I think in a diversified portfolio, I think in the current environment, there's definitely a place for it. It's not something that I would put half my portfolio in, let's say, but I think it can, be useful at the margin, certainly.
Any more questions?
Thanks, Phil. So I think really good presentation. What's your take on emerging markets?
Emerging markets are a challenging one. Emerging markets from a valuation perspective have been very interesting. Obviously you're in a part of the world very connected to some of the key emerging markets, and obviously what's going on in China just now is fundamental to that. China is the largest individual emerging equity market, if you will, and obviously a very significant one on the debt side. If you look at valuations and where you should be investing on that basis, emerging markets trade very cheaply compared to some of the developed markets, and especially compared to the US equity market. However, over the last 12 months, they've been a terrible place to invest in terms of returns. And that has been driven by a degree of risk aversion. There's been some geopolitical issues that have been taking place in there as well that have also pushed them down. There's been a lot of challenges with regards to Chinese companies listed in the US, for example, and also in Hong Kong. However, it is a very large, diverse market. You could look at kind of how the global economic situation is going to play out and who kind of the longer term winners from the disruption with Russia and Ukraine will be. And actually, there's a lot of things to favor China right now. And I think that's that makes it an interesting place to invest. However, it's a very painful place to invest at the moment. And even the onshore Chinese market has been very hard hit. So I think right now it will remain difficult and challenging in the short term because some of those geopolitical issues and some of the Chinese political issues that have affected that part of the market so much are still there. They haven't gone away, and there's still risk aversion from a lot of institutional investors. I think with a longer term hat on, it's a much more interesting place to invest. And I think when valuations start to become far more important than they are to investors at the moment, then emerging markets has a role to play, certainly.
Don't mind, can I ask one more?
Sure.
Right. So right now, looking at what's going on, it seems all doom and gloom, right? The war situation, inflation coming up, growth, maybe we're not expecting that much, high inflation. Can you kind of drive an analogy of something if that has happened maybe in history, and then how did the world really get out of it? It might be not possible. But maybe you can try.
Yeah. Well, I mean, look, I mean, the way I look at it is this. I've been in the investment game since '99, so I've lived through several crises before in terms of the dot-com crash, in terms of the global financial crisis of 2008, 2009. You know, we've had the COVID pandemic for the last couple of years and all the bits and pieces associated with that. Now, in terms of returns, whilst we've had this great challenge, actually asset returns over the last 2 years have been quite good. Who's to say where they'll go from here? So yeah, there's plenty of things that you could get very gloomy about. You know, I've highlighted a number of those in this presentation. But what I would come back to is this, which is we talk about investing. Investing is a long-term game, and frankly, there is light at the end of the tunnel. You know, I'm not going to say it's not going to be a bumpy ride between here and there, because it can be and it will be. But what history tells us is that asset prices rise over time. And what we should not get too caught up on is what has happened this week, what is happening next month, what is happening this year. If we are talking about people's long-term investment strategies, and when I say long-term, I'm talking 10 plus years, and for some people it might be 20 plus years or even longer than that, we simply have to take a view on what is an appropriate asset mix guided by what's happened over time. And if we find ourselves today in periods of volatility, you know, that can actually provide some interesting entry points. You know, if you can take advantage of that to come into the market, and you know, you're never going to buy exactly at the bottom and sell exactly at the top. Everyone would love to do that. The professionals, retail investors, everyone, that's what everyone wants to do. In reality, no one manages it. And if they do, it's by luck, and they'll never repeat it consistently over time. So I think the key message I would take is what history has taught us is that we have bumpy periods, but bumpy periods eventually come to an end. And that is the key thing, I think, to take away from it. Make sure you're diversified. Don't risk too much, because if you take those losses, that can do you serious damage. Don't chase the trend necessarily, because the trends end. If you're chasing it, you put too much into it, that causes you long-term damage. Diversify it, sit on it, and you will end up in the right place over time. And that is exactly why I picked that Warren Buffett quote at the beginning about sitting in the shade of the tree. It took someone planting that tree a long time ago to provide that shade. And obviously, the investment analogy is potentially your retirement income doesn't happen overnight. You have to plan for that well in advance to get to that stage. But you will get to that stage eventually.
Phil, Deepak here. How about India? I think that's one of the market which has best index this year compared to all the global indexes. If I compare as like Sensex and Nifty compared to other indexes. So what do you view in India?
So sorry, I wasn't quite catching that question. It was just breaking up a bit. Was it in terms of what's been performing best so far? Was that the question?
As a country investing into Indian market, as a portfolio, a single country, what's your view on that?
I think whenever you get into single countries, you're obviously starting to take more individual country risk. Now, clearly, whenever you invest in global equities, you're taking a lot of individual country risk, if you will, through the US, because that's just by sheer size, 65% of the global equity markets. When you start looking at other individual countries, and whether we're talking developed markets, whether we're talking emerging markets such as China, India, or whatever it might be, you have to be cognizant of the fact you're starting to take on much more concentrated risk when you do that. And my approach to kind of multi-asset investing is those positions are fine, but don't bet the entire portfolio on it. And I think especially as we go into the current period where we are, where there are some ups and downs, there are some challenges in front of us. Looking for some of those pockets of value is definitely interesting. I've already referenced China. China is a very interesting place from a valuation perspective, but it's lost 15%. The onshore market's lost 15% this month already, and it lost more in the previous few months as well. So sometimes, you've got to be prepared to accept that you could have these quite volatile outcomes from investing in markets that might look very compelling, but a compelling valuation does not guarantee that you'll get the investment return outcome you're looking for straight away necessarily. It will come over time, but you introduce certainly short-term volatility risk and concentration risk. So I'm not saying don't do it, but do it with your eyes wide open and within the context of your wider portfolio, ensure that the risk you take is suitable relative to the other assets that you possibly own and invest into.
Thank you. I have another one, technology. As you know, like it's one of the sector which has been hammered this quarter, inflation and any interest rate hike, it gets pretty much hammered in terms of the valuation perspective or from the market perspective. So my question is, you're right, if we invest to different funds or ETFs, the top 4 technology companies will be in every ETF of funds. Now, in the long run, what do you think about that? How much should be the allocation in this sector?
Yeah, so obviously the tech companies and the big US mega cap tech companies, the Amazons, the Googles, the Apples, and other kind of technology related ones, if you will, such as the Teslas and so forth as well. I know it's a car manufacturer, but people think it was a tech stock in many ways. Have been significant performers, very much over, and not just over the last couple of years. They had huge performance over the last couple of years, but especially over the last 10 years. And if you've been long US equity assets and especially tech assets, you've done fantastically well, and congratulations from that. The key thing that you have to be aware of, though, is that, and this relates back to that chart I put up earlier from Finviz. In fact, let me, no, I've taken the screen share off, I think, haven't I? The valuations there are very high. They've been recipients of a lot of fund flows as they help push those valuations to very extreme levels in many cases. And I think that is something that all investors have to be careful of. Technology is here. It's a very important part of our lives. It's only going to get bigger. I'm not going to say that tech isn't important and these companies aren't going to carry on doing good things. But at the end of the day, you have to determine, what are those good things worth? What is the price that those good things are worth, and the future growth those companies can deliver. And argue the case that those valuations have run well in advance of where perhaps they should have done. And I think that there is the potential that those valuations will revert to far more normal levels. Clearly, therefore, if you invest in global equities, if you do it passively, you are getting a high allocation to stocks such as that. So I think it's always useful, and this is something we do within the moderate strategy that we run and advise on here at Halwyn, is that we look to offset that by bringing some other strategies that help dilute that influence and that impact, if you will. So we have a couple of US value equity strategies held within our moderate model as well, which kind of help dilute down the fact that if you just buy global equity ETF, you're getting a lot of US tech exposure. So I think it's been a fantastic place to be invested, but I think from a forward-looking perspective, you've got to be cautious about exposure there and just be aware of the underlying look-through exposures you have in your portfolio.
Thank you. Phil, your multi-asset fund, how much is the allocation in technology?
So if we look at that on a look-through basis, obviously our primary exposure comes through our global equity ETFs. The global equity ETFs are about 2/3 of our overall equity weighting. And so within that, technology is a significant component within that. And that will make up a very large part of it. But that's why with the remainder of that portfolio, we obviously quite clearly diversify that risk away by having some emerging market equity exposure in there, and also some of that US value equity exposure within there as well. So it is a core component of it, but we're very aware of that, and we very deliberately look to dilute that with some other strategies within that. But obviously, those global equity ETFs we hold have a fair degree of tech exposure in that section.
Okay, 2 more questions as we are rushing out of time. And if you have any more questions, you can just drop us and we will reply you via email because our next speaker is waiting. But 2 more questions.
So looking at the market, the current situation globally, is it a good time to kind of pump in extra short-term funds for making right opportunity to get into the market with an additional fund in terms of, in addition to the regular long-term planning, is it a good time for a short-term additional infusion?
I'm always very aware of recommending anything that is timing related, because quite frankly, I don't know what's going to happen this week, next week, or in April. So I think it's very dangerous to get drawn into that. And that's the type of thing that I think you should only really look at doing if it's with incremental amounts of your overall investment strategy. So this isn't, you shouldn't suddenly be thinking about putting 50% of your portfolio into a timing strategy, because frankly, we could get it wrong. And if you get it wrong, you could lose a lot of money doing that. I think whenever you come across a fund manager who kind of runs a fund and they say, well, look, my strategy is a great one, I can go 100% to cash. When I think the market is going to blow up, I go 100% to cash. Well, not many people predicted 2 weeks ago the markets were going to have a 10% rally. It looked very much like they were going to carry on crashing, to be honest. So I think it's a high risk strategy. It's very easy to get wrong. And I think I would encourage you to focus more on the long-term strategy, if you will, and anything that you do that is more short-term and timing driven, to focus that more on at the margin of your portfolio. And the good old caveat you'll often hear in investing is don't afford to invest what you can't afford to lose, because who knows what Vladimir Putin's going to do tomorrow, who knows what the Fed's going to say at their next interest rate meeting. Is it 50 basis points, is it more? There's so many things out there that could cause the markets to move in either direction, up or down. It's a high risk strategy, so please, I'd encourage you to bear that in mind when thinking about it, and to focus the majority of your portfolio on a long-term strategy instead, where you can.
Any more questions?
What about energy sector? What about energy sector? That you didn't mention about anything about the energy sector. How should we look into investing in that?
So the question was breaking up, but if I've heard it quite correctly, was that related to the energy sector and investing in energy? Okay. So obviously energy's had a very good run. It's had a very good run, primarily driven by the fact that oil price has gone through the roof, energy price has gone through the roof, and that's obviously helped drive profits and margins for those large energy companies. In terms of what I do with my in terms of my model profiles that I run and the fund that I run, we don't take specific sector views within those. So we capture those within the overall investments that we make, but we're not going down and diving down into sector specific themes as such. However, the oil companies are very significant companies in their own right. So simply by having even just generic equity market exposure, you gain exposure to that. I think what you need to bear in mind, those equity prices, is they're driven by forward expectations, where people anticipate things are going. So where we stand today is that the great run we've had in energy prices, oil prices, gas prices, are pretty much baked into the prices you're seeing in energy stocks today. So kind of future upside to those is really driven by, well, how much higher can oil or gas prices go? And there's plenty of commentators out there who speculate on scenarios of $150 or $200 oil and so forth. And clearly, if we go to a $200 oil scenario, you want to be long energy stocks because they're going to keep on running. However, at the same time, over the past couple of weeks, we've seen energy prices tracking back a bit as COVID disruption in China has made people think, well, are we going to see a reduction in demand? And if you see a reduction in demand, supply stays where it is, then prices come back down. So I think, energy stocks have had a good run. How much more of a run they have from here really is determined by some of those supply-demand dynamics in the oil and gas markets, and whether we see $200 oil if we go back to $75 oil. And that's something at my level I don't play specifically. And you've got to have a very firm view, I think, on the direction of those underlying energy prices to really determine if you think there's greater greater play still to be had. And if you have, there are various sector-specific ETFs or funds or strategies, or even buying, direct stocks of energy stocks that can give you exposure to that. But I'd come very much back to my previous comments relating to emerging markets and individual country exposure. Be aware of the risks you take when you start taking sector-specific or country-specific views in your portfolio, and firm up and determine what you think is the best outlook for some of those underlying prices driving those before you do it. But please, with things like that, make sure you go into it with your eyes wide open, so to speak. They've had a good run. How much further there still is, I'm not so sure, would be my view.
You've only really talked about oil and gas, and that didn't bring in clean energy, water, solar, those types of energy.
Mate, I think you need to talk into the microphone.
ESG.
Yes.
Yeah, I did. Yeah. Look, I'm just framing this in the context of where we are at the moment in South Asia. I'd like to hear your thoughts on the potential to invest in property in ASEAN countries, residential, commercial, industrial, or otherwise. I'm not sure you have a lot of exposure to it, but if you have any thoughts, I'd like to hear it.
Okay. So in terms of property is not an asset class that we currently feature within our model profiles or in terms of the multi-asset fund that I'm involved with. One of the key challenges on the property side when you're running strategies such as that or funds such as that, which are themselves daily traded, is that it's quite a liquid asset class. So I'm not saying it's a bad asset class, but from what I do, it's illiquid. And the strategies I run need to have a degree of liquidity about them. So there's simply a mismatch in terms of the type of asset I'm able to own within those and property in terms of its own underlying liquidity. So I don't feature them within my portfolios or strategies. In terms of property as an asset class, though, just generally and generically, it is an interesting one, and depending whether we're talking commercial, residential, whether we're talking, European markets, Asian markets, there are obviously a lot of different dynamic factors in play. Certain specific markets, you can get some quite interesting yields, and I think when you've got fixed income as an asset class, with such low yields right now, if you can get asset-backed real assets with some degree of inflation protection, generating a reasonable degree of yield, by which I'm talking about 5% plus. That is interesting, I think, for most investors to think about and look at. Clearly, anybody looking at property there, you have to be aware of and consider the liquidity angle to it. It doesn't work for my strategies and portfolios as a consequence of that. It may be for your personal circumstances if we're talking about a long-term investment portfolio, that individually that some of you may be able to consider less liquid assets such as property. And that is increasing the diversification potentially of your overall portfolio away from just the other listed securities, if you will, of equities and fixed income and such like. And I'm never going to say a bit of extra diversification is a bad thing. Obviously, consider the way you go about it, the liquidity of what you do, and how appropriate that is within your overall portfolio. But I think in the current environment, there are certain property markets that look interesting, but again, do your homework, do your research before you look at anything like that, and really bear in mind liquidity. Because if you need to access those funds and can't, that's what hurts a lot of property investors over time.
Okay. So I think we will move to the next session as we are a bit short of time. If you have any questions, please feel free to drop us and we will get it answered by Phil later. So thank you so much, Phil. It's always worth listening to you.
Everybody.
I'm sure lots of years of experience brings that analysis. So thanks a lot. And thanks for answering all the questions. We will move to the next session. We have next speaker, Mr. Neil Chadwick. Neil is the head of technical services for the ISGL group of companies. That is RL360, French Provident International, and Ardent. He has over 20 years of industry experience assisting financial advisors with tax and trust planning solutions for their clients. Neil is also the chair of Isle of Man Insurance Association and a director of the IOM branch of the Society of Trust and State Practitioners. Tonight, he'll be sharing his thoughts on tax benefits of offshore bond investments. So over to Neil.
Thank you for the very kind introduction. I'm conscious that we're a bit behind time, so what I'll try and do is focus on the kind of key points on the presentation rather than labouring a lot on the detail, because you know, if anybody's interested in what I've got to say, clearly they can speak to the representatives of GFC. Before I start, I'd just like to echo some of Philip's comments that he made at the start of his presentation, in that everything I'm going to cover tonight is purely for information purposes only. It's factual. I won't kind of stray into the world of advice. That's what your hosts are there for. You know, again, if anything's of interest, then please feel free to ask questions at the end, or to speak to the GSE representatives at the event this evening. So first of all, I guess a lot of you may not be familiar with the name IFGL. So it's probably worth me just spending a few seconds talking about that. So IFGL is the parent company of a number of insurance businesses and also an investment platform. Key to the talk tonight, of course, is that it's the parent of Friends Provident International, who are regulated and authorised in Singapore in respect of the products that we make available there. It's a reasonable size of a business, over 26 billion US assets under management, and has a very good financial strength and rating. Whilst there is a presence in Singapore, we are stretched over 8 jurisdictions, but very much headquartered in the Isle of Man. So that's where a lot of our services are centralised, and most of the products that are available for distribution worldwide are Isle of Man products, although there may be a regional variant, which is the case in Singapore. So, you know, why Isle of Man? Why are we based there? It's a very stable and well-regulated jurisdiction. It's got you know, very tight solvency requirements on a business, and what it also has is a very, very good level of investor protection, in that if for whatever reason a financial services business, specifically an insurance company, were to encounter difficulties and become insolvent, then its policyholders are protected by Isle of Man legislation, in that they can receive up to 90% of the surrender value of their investment product as compensation, which is, you know, quite different to a lot of other jurisdictions out there. Investors also have recourse to financial services independent ombudsman in the event of any complaints. Now, of course, that's a real stopgap, but you know, the level of regulation, oversight, supervision in the Isle of Man is to such a high level now that you know, it's probably very, very rare that there would be any requirement for a business to rely upon the policyholder protection scheme that we talked about in the previous slide. So what does an offshore insurance bond offer? And offshore bonds are maybe something that you've heard about before, a term that you may be familiar with, but you know, what are they in reality? Well, what they really are is an investment product made available through an insurance provider. So a business that's got an local insurance license. So they're an insurance-based investment product in summary. And what they offer is a number of different features. Tax is a key one, of course, and we'll get onto that in due course, but they allow you to hold a wide variety of assets. So very key to what Philip was talking about before, in terms of being able to diversify your investment portfolio. They offer the ability for investors to transfer in existing investments. So particularly now, in current market conditions, there could be lots of people with equities that are trading below usual value. Rather than having to sell those assets, then those assets could be moved in to this structure if it's going to offer them a particular advantage. Because of the size of the group, we're able to negotiate very good discounts on funds and other assets that people would like to hold within our products. And then there are a variety of online services that are available as well, specifically dealing and also seeing how your investments perform from a day-to-day basis. So in terms of the types of assets that people can hold, very, very wide. So open-ended investment companies, OICs, ETFs, fixed interests, unit trust, stock shares, very, very varied. Providing the asset is meets our acceptability criteria, which broadly speaking is that it can be traded on a regular basis. It offers cash distributions, cash settlement, things like that. And typically we could look to hold that within someone's investment with us. So what we'll jump onto now are the kind of key tax benefits. Tax ultimately is one of the drivers that leads people to think and use our products. They do work very well from a pure investment perspective, but it's the associated tax benefits that are also real kind of value adds when you look at these type of insurance-based investment products. The first one we're going to look at is US estate tax mitigation. For those of you that don't know, if you hold assets within the US, things like mutual funds, shares, or physical property, then if you were a non-US person, so you're non-US national, non-US green card holder, then you've got a very small allowance in terms of the level of estate duty exemption that you would have if you were to die whilst holding those assets. For a US person, the estate duty exemption is it's $1,073,000, but for a non-US person, it's significantly less than that. So it's only $60,000. And any assets in excess of that will be subject to US estate duty at rates up to 40%. So quite significant. So where do our products come in and where can they help in this particular situation? Well, if those assets are transferred into the insurance product, then the insurance product provider becomes the owner. As the insurance provider is a company, the company can't die. And therefore, irrespective of what happens to the individual, estate duty wouldn't be due on the owner of the insurance product because they no longer directly own the assets that are held within the insurance product. So that's one of the key advantages. Another advantage is in terms of estate administration. So not only have you got the ability to be able to mitigate estate duty at anything above $60,000, but also if you think about what the estate would have to go through in order to be able to access those assets in the US. So various filings, etc. Again, those kind of situations can be mitigated by the assets being transferred in to the insurance-based investment product because the insurance provider becomes the owner of those assets going forward. So what type of people might this be relevant to? We see a lot of people using our products where they've been an executive in a US company, typically where they've received stock options in lieu of salary or bonuses. And then, when those stock options have vested, those assets can then be transferred into the insurance-based investment product. The insurance product then becomes the owner and therefore mitigates the US estate duty that could arise if the individual were to continue to own them at that point of death. And then, aside from those individuals, just general investors in US shares. It's an area that not a lot of people are familiar with, may not be aware of, and certainly worth talking to the guys at GFC about this later in the evening. Gross roll-up, what's this? I mean, this is a key thing with our products. Because the insurance company is the owner, the legal owner of the assets, and the insurance company is based and headquartered in the Isle of Man. The Isle of Man doesn't levy any ongoing tax on policyholder funds held with the insurance company. So what that means is that the individual's investments can grow virtually tax-free. Now, I do have to caveat that in that is subject to any non-recoverable withholding taxes that may arise The Isle of Man does have a number of double taxation agreements with various jurisdictions around the world, but where there isn't an effective DTA, and that DTA doesn't allow the Isle of Man financial institution to be able to recover any withholding taxes, then they will apply in that situation. But broadly speaking, the benefit of gross roll-up does is that it allows the product, or potentially allows the product, to the investments within it to grow faster than they would be if they were held directly by the individual or on an investment platform. There are no limitations in terms of the amounts that could be invested in respect of being able to benefit from gross roll-up either. So what we'll do, we'll look at a kind of quick case study here as to how that would apply in practice. So we've got Sophia. She's a 40-year-old expat, resident in Singapore on a work contract. She's got a sizable amount to invest and wishes to top that up on an ongoing basis. So how can an insurance-based investment product help Sophia in terms of mitigating future tax liabilities? So if she were to invest into an insurance-based investment product and then move back to the UK at some point in the future, then what she'd be able to do is mitigate any future UK capital gains tax. And the reason for that is because the investments are owned by the insurance company, and the insurance company isn't subject to tax in the Isle of Man on any kind of portfolio rebalancing or sales, etc., then no UK capital gains tax would arise because Sophia doesn't own those assets directly. So that's kind of where a key illustration of how this gross roll-up feature can work in practice. So in this situation, if we assume a growth rate, probably quite ambitious in today's market, but not so if we look at kind of what's happened in recent weeks and the stuff that Phil was talking about as to what we can expect to happen in the future. Then if she were to hold those assets directly, move back to the UK, sell those assets, then she could be potentially subject to a UK capital gains tax liability of over £10,000, whereas that wouldn't be the case if they were held within the insurance-based investment product, because the insurance company is the owner of the asset and not Sophia. So that's a really useful example here as to how that could work in practice. Another key thing when we're talking about capital gains tax and the differences between insurance, investment-based products and platforms is that the insurance products have a number of reliefs, specifically from a UK legislation perspective, that offer key tax advantages over directly held assets or assets that are held in platforms. In that, if you were to hold investments in a platform and then you move back to the UK, then you're going to be paying capital gains tax on the uplift from the very start the investment was taken out. Whereas with investments held through insurance-based investment product, the individuals can benefit from something called time apportionment relief. And what this does broadly is ensure that gains that have accrued during periods of non-UK residence remain outside of the scope of UK tax. So that essentially only the gains that have accrued since Sophia moved to the UK will be subject to tax at a future point in time. But the great thing about these products is the fact that they offer this gross roll facility is that they're tax neutral, and that it's very much the decision of the individual that owns the product as to when a tax event will happen at some point in the future. So as long as Sophia were to leave the product alone, plenty of trading can be undertaken, no tax event would arise. Tax events typically only arise whenever money is taken out of the product. And even in that situation, the individuals have got an allowance. So it's commonly referred to as the 5% allowance, more correctly referred to as the 5% tax deferred allowance. And what this does is it enables individuals to take out 5% of the total premiums paid, so the total amount invested in the product each year, without being subject to a UK tax charge or without having to have any filing obligations. This 5% allowance is also cumulative. So if we use Sophia as an example, if she took out the one of these products now, 5 years later, moved to the UK, she would have accrued 25% of an allowance that could be withdrawn from this product without being subject to an immediate UK income tax charge and without having to go through any kind of filing obligation or income tax assessment on the monies withdrawn. So they're a really useful product in that very tax neutral, offer the estate duty tax mitigation, and also the ability to be able to access funds in a tax efficient way, providing you stay within the parameters that are permissible under UK tax legislation. Where they can also add advantages is with other jurisdictions. So, UK capital gains tax, we've kind of talked about that already, in that that's mitigated because the assets are held by the insurer and not by the individual directly, and therefore no capital gains tax charge is going to arise on the individual that owns the insurance product because of the way that the assets are structured, and no tax being charged in the Isle of Man on policyholder funds that are held with the insurance company. But the products are also really good for individuals that are looking to mitigate against UK inheritance tax liabilities, specifically for somebody that's UK domicile or retained a UK domicile of origin. In that, for individuals that fall into that those categories, then their worldwide estate is potentially subject to UK inheritance tax at 40% over £325,000, which is the UK nil rate ban. Now, insurance companies like ourselves have a number of trust-based solutions that can be used by individuals to mitigate against UK inheritance tax liabilities where they're a UK domicile or are likely to retain a UK domicile at the point of death. And in the latter, an example of that would be an individual that, although they haven't been resident in the UK for a long period of time, and potentially think that they've acquired a domicile of choice in another jurisdiction, if they are quite transient, so they move from jurisdiction to jurisdiction, then they may potentially never be in one particular country long enough to be able to determine that it's their long-term home and the centre of their universe. And they always run the risk then of the UK determining that they've never lost their UK domicile of origin, are still UK domiciled at the point of death, and therefore their worldwide estate is subject to a UK inheritance tax assessment. So a number of different solutions that are available, whether that's somebody making outright gifts, whether they want a trust solution that would offer them the ability to retain access to the capital, having access to an income for the remainder of their lifetime, or a combination of both. There are solutions there that certainly are available. For non-UK domiciles, particularly those that will end up will move to the UK at a point in the future, or another key planning opportunity here is where you've got individuals that are in mixed domicile relationships. So one party is UK domicile, one party is non-UK domicile. If planning is done by the non-UK domicile party prior to remaining long-term in the UK and becoming deemed domicile from a UK inheritance tax perspective, so that's where the non-UK domiciled individual has been resident in the UK for 15 out of the last 20 years, where that situation occurs, and that individual is then treated as if they were UK domiciled from origin, in that their worldwide estate is now subject to UK inheritance tax at 40% over and above the tax-free threshold of £325,000. The non-UK domiciles, they can do very, very tax-efficient structures linked to these insurance-based investment products, in that if done at the correct point in time, assets held within an excluded property trust can remain outside of that of individual's estate for UK inheritance tax purposes, even when they become UK deemed domicile at a point in the future. Now, there are a few caveats around that, and this particular session isn't long enough to go into all of those levels of details. However, broadly speaking, providing the individual doesn't take the trust fund by making additional contributions to the trust as and when they are deemed UK domiciled, then those assets will still remain outside of the estate for IHT. Equally, they need to make sure that any assets that are held within that particular trust structure are non-UK citus assets, so they are non-UK. And that's where these insurance-based investment products from the Isle of Man and other jurisdictions add value, because they are non-UK products. Lots of people still kind of confused as to where the Isle of Man is. Whilst the Isle of Man is a crown dependency, it is not part of the UK, and therefore Isle of Man products are not UK citus assets. Moving on to other jurisdictions where there are significant kind of benefits. One of them is Australia, and that Australia have a really simple tax treatment as far as these products are concerned, in that providing they are held for more than 10 years, then any benefits that are taken or any gains that accrue during that period of time are not taxed. They refer to the gains as a bonus. So providing the investments have been held for 10 years or more, then from a year 11 onwards, the product can be encashed in its entirety, or withdrawals can be taken from it, and none of the proceeds are subject to Australian income tax. They're taxed under, I think it's section 26AH of the Income Tax Act 1936. Very old piece of legislation, but as far as Australia are concerned, it works very well for them. So where does this add an advantage? Australian expats moving back, so they could look to restructure their wealth into these types of products, providing that they're prepared to hold them for 10 years or more. Then any profits, gains, etc., that arise on the product can be encashed. A regular income stream can be taken, and none of that will be subject to Australian income tax. People migrating to Australia, so maybe they've been on a short-term contract or long-term contract overseas. They've decided that they want to retire in Australia. Maybe they've got an Australian, husband, wife, partner, etc. Again, these products are really useful. And again, because of the facility to be able to transfer assets, existing assets, into these products free of charge, then they're not looking to maybe sell out at a point in time like now where the markets are very volatile, in order to be able to take advantage of a solution that would be able to offer them tax benefits at some point in the future. And then the final kind of area here where they can have an advantage, if you've got children that are in secondary education in Australia, then gifts from these products can be made to those individuals. And because if the product has been held for 10 years or more, then gifts to the individuals would not be subject to tax. And again, where that works particularly well is not just people that are in secondary education, but if you've got Australian beneficiaries of a will, then again, whether the product is being transferred over in its entirety on the death of the owner, or the benefits from it, so it could be encashed, and the benefits from it could be inherited by the individual, and those benefits wouldn't be subject to tax because the product is subject to the income tax legislation I talked about, where provided it's been held for 10 years or more, post year 11, then the proceeds are tax free. Where withdrawals, etc., are taken prior to year 10, then there is a kind of rolling kind of tax basis. So up until year 8, then 100% of any gain, not the amount that's withdrawn, but the gain comparative to the amount that's withdrawn, would be 100% of that be subject to tax. After year 8, after year 9, 2/3 of that would be subject to tax. After year 10, 1/3, and then after year 11, all the proceeds or any amount that's withdrawn is completely tax-free. So conscious that we've kind of gone through a lot of things there in at quite a pace, but equally conscious that I want to kind of keep you guys on track and make sure that none of you go too hungry and get to your dinner. So if there are any questions, I'm quite happy to take those questions now, or equally feel free to chat to the guys at GSC over dinner or send questions, and if need be, they can pick them up with myself at a later point in time.
Hi Neil, Deepak here. On a state tax of US equities. So I'm working with GFC, and I just want to bring this topic to you because a lot of Singaporeans and peers or the foreigners here, they hold US equities here, US shares. So just on a state tax, which you mentioned about 18 to 40% after 60K USD. I'll give you an example. An individual who is holding $500,000 of USD Microsoft shares, either on a Morgan Stanley, OEMs, Interactive Broker, or any DBS platform. If something happens to the individual, does he gonna incur or she gonna incur the tax of 80 to 40% if there's a no insurance wrapper?
Yes, potentially. Now, I will just caveat that by saying that it does very much depend on the existence of a comprehensive double taxation agreement between the country where the individual was resident, point of death, and the US. Now, some jurisdictions have very comprehensive double taxation agreements, which offer the individuals in the non-US country the same level of estate duty exemption as a US person, but not everywhere. So that's something that you have to be very mindful of, in that a careful consideration of the double taxation agreement needs to be reviewed to determine what kind of liability could arise at the point of death of the individual. If the DTA doesn't offer the full US exemption, then, as you say, they could be subject to those levels of estate duty on assets above $60,000.
Indian passport holder. I'm giving you a little example. Indian passport holder, Indian staying in Singapore as expat, and if he or she dies in Singapore or India, apart from US, will I incur the state tax on my US equities if it's more than 60K USD? Am I right to say that?
Yeah. I haven't read or referred to the Indian double taxation agreement with the US in a long period of time. That's something I can certainly check for you after the call and provide that information so that you can share it with the people that have attended the call today.
Thank you.
Neil, this is a very important question. Does it apply to Scotland, or has that horrible lady changed the rule?
It's a very good question. In that, although you've got devolved administrations in Scotland, Wales, and Ireland, they're all subject to the same income tax, capital gains tax, and inheritance tax rules. And it's amazing, really, the amount of people that do think that there are different tax systems in the various administrations, but they're all very much the same. Where Scotland can differ, I think there are rumours around potentially having slightly different income tax rates, but certainly the inheritance tax legislation is exactly the same.
Thank you. So in summary, yeah, it's the name. That's my impression. Listen. Okay, I'm an Australian citizen living here in Singapore for maybe a little while. Quite a few years. If I make an investment here and let it mature over 10 or 15 or 20 years and pick that up back in Australia, would I be subject to CGT?
Now, with a life assurance product under ATO legislation, then providing it's been held for more than 10 years, then anything you take out of it from year 11 onwards is not subject to Australian income tax or CGT.
Cheers.
Any more questions?
If anybody has more questions,
Just drop us an email. I will anyways be sending you the recording so you can direct the questions to us. Perfect. Thank you so much, Neil. Thank you. Whenever someone says about tax, we are all like, how do we reduce it? So thanks so much. It was really informative. We will move to our last section. We have Deepak. So he'll be presenting on CPF investments and SRS investments. So I'll just give a quick intro about Deepak. He has been with GFC for nearly 8 years and has established himself as one of our top performing consultants. He specializes in financial planning, insurance protection for individuals and groups, as well as advising on CPF investments. Deepak currently has an asset under management of approximately 85 million Singapore dollar. So over to you. Yes, everything.
Here, my wine. So good evening, everyone. So I hope you are enjoying the session here. First seminar, live, and good to see the attendance here. So the live activities are back in Singapore. Hope to have more in the future. So I'm going to discuss about CPF and SRS. Before I go into this, how many people in this room are Singaporean and PR? Can I just get away with it now? Okay, that's good. I can still speak about CPF today. How many have a SRS account, supplementary retirement scheme? They know about SRS. Okay, so that will be the second topic, which will be very beneficial for the individual who can save a lot of tax in Singapore. So somebody talked about the market, Phil. Second one, talk about the offshore tax, but you can save some tax in Singapore and draw your money to you on this. So I'll likely jump on CPF. Second slide, please. Okay, this is before 55. Who are having a CPF accounts here? Before 55, they will have 3 accounts: ordinary account, special account, and Medisave account. People who doesn't have a CPF, when they become PR tomorrow, they will have these accounts too. So ordinary account you can use for the housing, which is like to pay for down payment to buy a property in Singapore and pay for the mortgages. Second is PRs can only buy condos and Singaporeans can buy HDBs, and unless nothing had changed in the last budget session. This is what my understanding is there. Insurance, of course, you can buy insurance from the local providers. Investments, I say professionally managed portfolio, so you can invest your CPF. Education, so you can pay for your kids' education fee in Singapore. Retirement, of course, that's the thing which I'm going to talk about and how the CPF is going to be beneficial for you. Special account is useful only for retirement and for the investment again in a professional managed portfolio. Medisave is just like an account which you can use for the hospitality bill to pay, and for the Shield plan which Singapore offers to the Singaporeans and PR, where they can put a premium using that and get a coverage on this. Now, ordinary account pays you 2.5% interest rate per annum. Special account give you 4%, and Medisave also 4%. We can invest ordinary and special. The golden rule is you should be 2.5 and 4. That's the reason people like to invest in the market. Medisave, you don't do anything with this. It's only for the medical purpose and mostly for the paying the premiums for your Shield plans of this. Slide, please. So this is actually a long time back. I like to bring this one of time in my seminar because I started with GFC in 2013 and started meeting a lot of CPF clients, and this article pops up from nowhere that saying that a lot of people who invest with CPF actually they lost their money 15% only made more than 2.5, and 40% just made losses. So like for me, meeting a client and telling them the thing like, hey, listen, I can make you more money than 2.5. This article pops up, makes my life difficult. What it articles tells you just to be careful with your funds. It's a pension. You need to know your risk profile, where you're going to invest. And that's a lot of things that happened in the past without taking any names here. The things in the last 10 to 15 years, 9 to 15, a lot of people have lost the value in the CPF. That's a lot of changes that happened in the last 5 to 6 years too, that how the CPF can be invested. So this is important, CPF at 55. So 55 is considered to be an intended retirement age in Singapore. Not 62, but CPF says 55 you should retire. That's what my understanding is that. So there is account, ordinary account, special account, MediSave account. There is a one account opened up on 55th birthday is called retirement account. And that's very important for Singaporeans and PR to know about this. How are the retirement account created? So CPF members need to fulfill the retirement sum. So retirement account come with a retirement sum, which is classified into 3 different categories: basic retirement sum, full retirement sum, and enhanced retirement sum. What are these? We'll know in the next slide. Can I go on top?
Yeah, go ahead.
So my weight is, I lost a lot of weight. So this is a table which shows you, these are years 2022, 23, 24, 25, 26, 27. That's the year telling you that like which year you're turning 55. And basic retirement sum, full retirement sum, enhanced retirement sum. There are 3 different numbers. And if you see, as the year passing, they're increasing. They're adjusted according to inflation, which is 3.1, 3.2%. So if anybody, Singaporeans and PR here, or tomorrow when going to be PR and turn 55, you have to fulfill this retirement age. This year, basic retirement sum is $96,000, full retirement sum is $192, and enhanced is $288. Now, every individual by default, they need to fulfill the full retirement sum, or they can choose for enhanced retirement sum. The reason is the payout. These are the annuity payout. Approximately, you're going to get it at the age of 65. So depending on what you choose here, this is the payout going to start at 65 till your life in a CPF. Now, I'll explain to the case study, which will be easy for you. So case 1, to understand, let's say that May, who turns 55 in 2022, she has not utilized CPF for her property. So it's a pure saving in a pension, which is ordinary account, 300,000, special account, 250, and MediSave, 63. Now on her 55th birthday, the retirement account will be created. That's the 4th account. She needs to choose either full retirement sum or enhanced retirement sum. Remember that? The 2 account which I mentioned, full or enhanced. Let's say she choose full retirement sum, which it was this year, $192,000. The balance from CPF special account. So the first thing, it will come from here. Will move to retirement account. Now the account will be 300K, $58,000. MediSave is 63. A retirement account is $192,000. RA, so retirement account gives you 5% interest per annum, which grows. And will be locked till 65. You can't touch that pot. Before the annuity starts at 65 of 1570 from that table, approximately, they're going to give you on a monthly basis till your life. But at the 55, she can take the balance remaining from the ONSA. So if you add the balance, it is $358,000 at 55. And whatever the future contribution gonna go into CPF, you can take it as a withdrawal. So the point which I mentioned, the 2.5 and 4%, more importantly, the point if you utilize your CPF not in a proper way, you may not even the situation. This is a really good account which I'm talking right now. This in Singapore basis. Now let's say second case study. Same person, the difference is here, she bought a property. A lot of Singaporeans and peer utilize their CPF for buying a property in Singapore. Expats who turn peer, they use CPF to buy a property. Now, see, you bought a property, remaining lease must still see that at least 95-year-old. That's a condition. If their OA is 120K, why it's lower? Because she must have utilized for the property. So CPF OA is used for down payment and mortgages. Special account 250K, MediSave $63,000. Same rule on 55th birthday. Everything works well, save the full retirement sum. 192K is taken out from special account. This is the remaining balance. OA 120K, special account $58,000 because it's taken from 250 minus 192. RA $192,000. Now here she has an option. If she wants to withdraw more money at the age of 55, she can pledge her property to take more withdrawal at the age of 55. So at 55, she can take the balance remaining 120, 58, and also she can take $96,000, which is from a retirement account. And why $96,000? Can you go to 2 slides back? Because BRS is $96,000. If next year this goes up, she can withdraw $99,400. If you see the maths, it's multiplied by 2 and it's multiplied by 3. So at 55, go to second case 2. At 55, she can withdraw $274,000. But what she's gonna lose here, she's gonna be demoted from a full retirement sum to basic retirement sum because she has taken $96 out, which means the payout for her will be just $800 from 65 onwards. So the person need to decide here that how does she gonna plan her retirement or his or her at 65. But there's an option given to you. So case 2 will be treated as a basic retirement, which means that May will get an annuity approximately $850 per month. So what GFC does and what I do with my clients. So I meet them before 55. Every individual have a different need. We take their CPF money out, ordinary and special account for the investments. Try to beat the returns, 2.5 and 4%. Some individual like to buy the property, so we grow their money. When they need a property to buy, when they find a property, yes. Second slide, probably second slide. So ordinary account is 2.5 and 4. Somebody like to invest their OA, grow their better than 2.5, sell it out, pay for the down payment for his property, for her property. So we like to work till 55, try to get a better return from CPF, sell the funds, depending on what their CPF situation look like, goes back to the CPF, sell the investments, fulfill the retirement account. I always encourage my client to go for the full retirement account enhanced because there's a 5% interest earned on that amount. For 10 years, you won't find in Singapore anywhere. And it's tax-free. So I always encourage that. But after that, most of my clients, so I will have, since my 8 years, at least 23 or 24 clients who had turned 55. Out of 23, everybody have fulfilled the full retirement sum. It's not that we have grown their money, but also they have done their portfolio quite well in terms of their utilization of CPF. But their fulfilled retirement account, they take the money out and they invest with us in a cash form, which is an open architecture investment, which Neil was talking about, the offshore bond. So your annuity starts 65. Yeah, the client has an option to take the money out. If you go to the case 1, she can take it out, or in this scenario, $358,000. We can build up the portfolio depending on the client risk profile, and we start something an annuity plan for the clients to cater their personal needs. You don't need to wait till 65. depending on the client risk profile.
I think with the really exciting man at the end of
At least your assets secured in a worst case scenario, something goes wrong on this. This is what I've been doing with my CPF clients till now, but I'm going to give you a little idea what we do CPF. So these are the sample portfolios, and trust me, I've just taken out last evening, given to Tiffany. This is last 3 year returns on CPF OA. So one thing you need to understand, when you invest your CPF, it has to be invested by a CPF approved funds. You cannot go and invest anywhere else. So, and CPF ordinary account can be invested with equity funds, balance funds, and a fixed income instruments. So this client who has invested around 113, value is 158. This money has not given to one go. This top ups that happened, but the absolute return is 25.79. So if I do the math, it's more than 2.5 or 3% over here in last 3 years. Last 4 years, similar different portfolio. CPF OA, 37.59. Now, depending on the client risk profile again, somebody can be younger, get more risk here. If you're turning till 55, then we have a capital accumulation, capital protection, capital realization, which I can discuss in the next seminar, but not here. So that's also more than a CPF OA. By the way, this CPF OA funds can be also invested via cash. So I'm just telling you CPF OA what they would have done in the last 4 years. Last 5 years, 40.49. All the CPF funds. This is a special account, and this is again a OA funds, 40.49. This is a special account. So a special account cannot be invested to any equity funds. It has to be a balanced or the bond funds. And bond funds to earn 4% interest. Please tell me if you have anything. Please tell me like we can do that. I don't think so. Any bond fund can earn you 4% SGD return on that. So it's all funds are balanced, which gives me a dividend of 3.3, 3.4% also on that. So the returns which you're seeing is the growth, not the dividend inside. Again, the returns are more than 4% annualized basis. This is last 4 years. So that's around 31.88. The bond is here just to protect us some capital, which was happening around in the month of November, in the month of January actually. Otherwise, I don't like to invest in these bonds. Okay, so this is my first client who turned 55 when I was working. So they turned 55 at the year of 2017, I guess, 17 or 18. And he put a full retirement sum, took the money out, bought a car, and the rest of the money given to me invest in open architecture investments. So I know them from I know them from last 8 or 9 years. I mean, I asked him to be here, but they were not. They're not Singapore. But this was my first client who actually had a proper CPF 55. They would have given experience of that. Okay, this is more interesting. This is valid for a lot of people here. How many people know what SR is? Just can I have again one hand? Okay. Supplementary retirement scheme. So what is SRS? Supplementary retirement scheme is like a pension or like another ordinary pension for Singaporean peer after CPF. And for the foreigners who doesn't have a pensions here, they can start contributing to SRS. What it says, contribution to SR is eligible for tax relief. Everybody laughs me like, how do I save my tax in Singapore? Yeah, there's a very limitation which we can save my tax. Anyways, people are from UK, Australia, you pay less tax here. But still they want to save more tax on this. There is an option. We can do that here. So contribution to SRS are eligible for tax relief. Investment returns. So when you do a contribution to SRS, do you know how much is the return they give you the bank? Anybody can tell me what the returns they give you in a bank? SRS, yes.
0.05.
0.05%. I think you don't need an advisor to build up a portfolio and beat 0.05. You can do by yourself if you do that. Save a tax, make more money than 0.05. Unfortunately, MIS has not enough to invest into Bitcoins, but you know what? Maybe in the future, they're going to allow you on this. So,
look, I can stake crypto right now and make 8.2%. annually.
That's good for you.
You're in this room to do it.
Now, what I'm saying to you right now is more about the holistic approach of the planning when you do an investment asset allocation of this. So Bitcoin is a part of investment strategy. If I'm not mistaken, Tim Cook holds 2% of the portfolio in Bitcoin.
Fair enough.
So that's good to be there,
I,
right?
I was winding you up.
That's fine. I still need to have a lot of wine for that.
Deepak, I'm asking for a friend. What's a mental disorder?
Ask Singapore about this. So opening an SRS account, so Singapore citizens, PR, and the foreigners can open the account here. And you must be at least 18 years, undischarged bankruptcy. Now, a bankrupt now having a mental disorder. So that's a definition come from Singapore website on this. And capable of managing your sovereign affairs. These are the various eligibility criteria which you do open a SRS account here. You can open it with DBS, OCBC, and EOB. So there are 3 banks which you can open it. And once you open it, if you put the money inside SRS, they only give you 0.05. Then you need to look people like us, or you start managing your funds all over Bitcoin. Documents requires very straightforward, your passport copy and IC copy, straightforward, you open an account on this. Now how it works. So let's say Mr. Tan, who is a Singapore citizen and PR, who contributed 12,000 as a SRS. So this is the one column which is important. Singapore citizens and PR can contribute up to $15,300 per year the cap, where the foreigner can do $35,700. So this is like a little huge gap between the Singaporeans and the foreigner side. So this guy is a Singaporean who put $12,000. SRS will tell the IRS guy, like, hey, this gentleman has put $12,000 into SRS. Tax relief will be given at $12,000. The personal tax relief, which I learned 2 years, 3 years back when I was working on my tax, that if you exceed more than $80,000, then please, I think Tim, we had a discussion about this, like talk to the tax person or get an accountant to make your work on tax. So $80,000 is a maximum we can do a relief in a year for any individual. But if you exceed more than that, you need to hire a proper accountant to do this for you. I will tell you like in a more maths, like how it looks like. So can you see these numbers? No, right?
No.
So I'll read for you. So let's say example, an individual foreigner who earns 200K as annual income. On 200K, the tax comes around $21,150. So without any relief here, if I earn 200K, I'll be paying a tax of $21,150 for that year. If I'm on the same pace, I will just give you a few reliefs, like you can actually file for that. If you are paying any life insurance in Singapore as a premium, for you and your spouse can incur up to like $5,000. You can take as a deductibles. And of course, SRS contribution too. But this is without any other deductibles. It's only without, there's like 200K. The person pays 21,150 over the tax. But if he pays $35,700 contribution in SRS, he incurs a tax of $14,724. So there's a saving of $7,000 on a tax bill. So in this case, I think he was paying around 11%. In this case, he's paying 7% on that. And that money can be invested into open market, which you can grow, and that'll be a good value. There's a lot of like, this is one of the relief is given. Another column, like if somebody's earning 350K bracket, on 350K, you pay without any SRS contribution, $51,150. That's a tax bill. But if you do a SRS contribution, the tax bill reduces to $43,400. How do I advise my clients this one? Don't go and put a tax SRS in the first day. Look at your whole year annual income. Look at your deductibles. Take a decision on November and December. That does it make sense this year to pay money into SRS? If it doesn't make sense, then why you want to do that? You can always use this Excel sheet to tell you like how much you're going to save a tax on that. So think wisely when you do SRS contribution. But you can save a tax up to 5 to 10%, then you should do it actually. And you can invest. So this is another portfolio. SRS can be invested into SRS approved funds, but it treated as a cash. You can invest anywhere, any market in the form of mutual funds, ETFs, and SGS stocks. So I use fund strategy for my clients. This is last 3 years. Returns are 38.52, 0.05 is the benchmark here, I guess. So pretty much we talk about that. Last 4 years, 44.44. And here another one. That's it. This is what we do with the SRS contribution. You can save tax. You can build up a portfolio for the foreigners. You can use it as a pension for yourself. And for the foreigners, there's a one thing. If you hold your SRS for 10 years, and after 10 years, you can withdraw all the money in one lump sum. There's no penalty on this. But if you withdraw before 10 years, there's a penalty of 5%. And 50% of the income is taxable. Okay, now, please.
That 5% that was mentioned, would that on the interest that you earn on investment?
Yes, 5% of the portfolio value on a penalty.
10 years is from the date of first investment, or 10 years is from the date of every year?
10 years of the holding period of your investments. So like 2021 to 2031 for the foreigners.
So
And if you have to withdraw in one lump sum, if you don't withdraw in a one lump sum for the foreigners, the rest SRS which you withdraw, they'll be taxable, a penalty of 5%.
50%.
No, then you will need to wait till 62 years because Singaporeans and PR cannot withdraw till 62. This is only for the foreigners. 10-year rule.
2021, if I invested 10 years after that, 2022, you invested 10 years.
No. Holding period of first account.
From the date of opening of the first investment.
Say I open an account now, and 5 years later I left Singapore, back to my home country. Okay, 5% fee. Is there any investment on any of the investments or anything? Does it vest or does it expire? Do I have to forfeit anything?
No, so let's example, I put $100 today, and after 5 years I leave.
Yep.
So what is say to as a foreigner that after 5 years, if you don't want to contribute, it's fine. It's a voluntary contribution. But if you want to withdraw within the 10 years, either you are in Singapore or either you are overseas, there's a 5% penalty and 50% withdrawal tax.
However, just to add on to that, if I move back overseas and I still let that go for another 5 years, while I was here and I wasn't contributing anything, would I avoid all of those fees?
Yeah, so if you hold for 10 years and let's example, you put $100, you don't 5 years, you move back to Australia. And after 10 years, you withdraw the $1,000 and it becomes $1,000. You don't pay a 5% penalty on that. But of course, you'll be liable to pay 50% of a taxable income in Singapore. So anytime you withdraw from SRS, 50% of our taxable income is 50% of the value is taxable in Singapore.
So if I made a deposit and I left it tomorrow, however, I didn't touch that for 10 years, I would avoid the.
Yeah, all the fees, 5% penalty. That's the fees you will want to avoid that. I actually printed that one because I got to know about this. There's a various situation you can withdraw the money without the fees. One is that if you get bankrupt, I hope nobody does it, but if it is declared as a bankrupt, there is no penalty fee imposed. And if you have any critical illnesses and you get admitted in for a terminal illness, you can almost withdraw up to 50% on that. So I can share this with you. Like there's a lot of in and out, like you can withdraw the funds on a different time of this for SRS.
If I can make that a bit clear, the 50% is that on growth?
On the growth portfolio value. So if you put $100, become $1,000, it's 50%. So look, what happens normally people
On the growth.
on the growth, on the whatever the value gonna be there. So normally what happens is treat like a pension, like you only withdraw it when there's no huge income for you. So if you're having a work, paying a tax, you don't want to withdraw the same because So you would like to work on that numbers. Yeah.
Yes, but 50% is unavoidable, even if after you after
By
10
that by
years.
default you need to pay.
What happens if you are not in the country after 10 years? You still pay 50%, you pay the tax to the residing country. Supposedly.
Capital gain tax? Yes. Depends on the country which you are in. Yeah, in India too. Yeah. Depends. So that depends like that year. So this is a supplementary retirement scheme, right? So if I'm retiring somewhere, I may not have an income that year, right? So you're not paying any huge tax on that. So you're taking a structural withdrawal instead of taking a whole withdrawal amount. You're taking a withdrawal which makes sense in your tax year.
But anyway, after 10 years, because you have to withdraw either full or either you have to wait till you turn 62, right? So no point waiting till 62. You have to wait at whatever time.
Now, so 62, after 62 also, you have to pay 50% taxable. So how does people treat this as a pension? Is like in a year where I don't have a huge expense and as a tax bill, I try to take a structural withdrawal. So this is treated as a pension. So you take an annuity withdrawal from it. If somebody want to withdraw everything, then you need to pay a tax of 50%. Basic example, if you're withdrawing $1 million, it's a $500,000 taxable, and $500,000 in Singapore will tax you almost close to more than 80 to 120K SGD if I'm not mistaken. So nobody like to withdraw at one time. 50. Yeah. So no, so 50% taxable is all the way. All the way. Yeah. Choose how much amount you do. So, let's example, if I withdraw $50,000 today, I don't have an income in Singapore. It has become $25,000. I just pay a very minimum tax in Singapore. Not FBI. So we can transfer the. So we use iFast for this because they have SRS. Now we can't. The SRS, the government doesn't allow us.
Can I give you a starting of the year $35,000 or iPass at the end of the year when you transfer to SRS?
No, that's totally not advisable. With a lot of regulations now, because they will not treat as a SRS as an input into FP or any portfolio bond. They treat separately on this, and I would not advise you to take a withdrawal because that's not advisable as an advisor to you to withdraw this. Treat it as a pension.
Okay, I think.
If I include the cost of funds of the unit trust, how much does it and cost of management? The unit trust fees plus.
So the portfolio which you have is after the fees. This is all taken by the fund managers. Go to the sample, SRS one. Go in the past. Yeah, this is after the fees. Everything.
Yeah, right. If a PR, the person's PR expires, right? What happens to the PR?
Two options. You can take the whole money out, or you can leave your CPF. And when you come back after beautiful, like 10 years spending outside, come back and say like, hey, listen, I have a CPF here. Can I apply my PR? Chances of getting PR is quite higher. That's what I'm saying. But this is happened to one of my clients. So you were still under interest rate and everything on this. So, but you have an option to take all the CPF money out, and also you have an option to leave it over there. When you come back, you can take it away. No tax on that because the pension you already paid are tax in Singapore. No. Until India changed the rules. Not as far as. Yeah.
What happens in case of the person?
It's paid to a nominee, so there's a nominee option for you. So you can put a nominee and get the money off. Everything. No, there's no tax for inheritance in Singapore. Secret. Done?
Yeah.
I think everybody's hungry, but I'm hungry.
Yes.
I need a wine. So thank you very much.
Perfect. Thank you so much, Deepak. We all know about secrets and our but we don't know all the options available. So thanks a lot. And so now we are done with the seminar session. We still have like yummy food waiting downstairs. So thanks to each one of you. Thank you so much for coming tonight. Thanks to the marketing team of JSC, Tiffany and Anisha for making this evening happen. Thanks to all the speakers and thanks to the Yacht Club guys. You really do a great work every time we do an event here. Thank you so much. So we can go downstairs now. Thank you.